Welcome all. Welcome to class 7 of CM1. Now comes premiums payable annually. This is the company. It used to be like this. Policyholder is here, and we say at the outset, at the policy inception, when policy started, at that point of time, that is zero, policyholder has to pay premium to the company. This is a whole life policy. So in this setting, we started at a basic level. If you remember, the policyholder has to pay a one-time premium here. That's all. And then whenever the policyholder dies, this is the year of death now. And if the company is entitled to pay sum assured, whatever is decided at the outset, that amount, then what is the equation of value? Okay. So one income for the company, one outgo for the company. At one point, company will get some amount. At one point, company will pay some amount. That point is end of year of death here. At the end of year of death, company has to pay this amount. The person dies during this. And this is K2, K plus 1. K is a random variable. Now in this case, the equation of value where we have written expected present value of income is equal to expected present value of outgo. Here this is 1. At 0 we are finding. So this will not change. That is one time premium P. Let me write here. Or maybe let me write here. Expected present value of income, that is P, and expected present value of outgo, S. But our equation of value stands here. So P is here, will not worry. But S we have to bring here. Not the present value, but the expected present value. Expected present value of S, that is S, A, X. It depends on A is here. If you write X here, this way it will go. So the expected present value of income is equal to expected present value of outgo, which is our equation of value. That was this. We already know this. This is a kind of recap. If you remember, I said you before, we never change the left hand side. We never change the left hand side. We never changed the left hand side. In today's class, we'll change the left hand side because the income will no more be one time for the company. Okay, company is the subject here. We know this already, nothing new here. Now come to this. In this case, company is saying you pay the premiums every year at the start of each year, even if it's not mentioned in the question. Remember, whenever you come across a question saying to pay the premium annually or more frequently than a year, in that case, it will start in advance always. So this P is not equal to this P. Remember, this P is not equal to this P. Maybe I've written a capital P here, small p here. That's a separate thing, but they are not same because now the company will take so many payments from you. It's like you are paying the tuition fee every year or every month, whatever. So now this is an annuity. However, whenever the person dies, company will not accept any payment. Even company will not want to take any payment because that will not be a good thing. Okay, once the person dies, person will not pay any amount to the company. Then company will come to the rescue and company will pay this amount. This is the amount company will pay once the person dies at the end of year of death. Okay, there is no change in this side. There is no change in this side. Okay, so if I write equation of value here, income and outgo part will not change. Outgo part already SAX, it will not change. The only thing will change now is the left hand side, that is expected present value of income. Remember, this will be PAX due now. Why due? Because this is annuity in advance. Okay, and if you compare with part 1, We are not interested in the number here. We write the present age. There is a difference. Okay, you have to differentiate this one from part 1. I'll go to that. Here this is kx, this is kx plus 1. So when you write k here and you write x here, automatically k means kx here, remember. So this is our equation of value. We'll try to know what is x due, never mind, but the present value of all these will be Pax due. Okay, suppose we'll solve a problem. Here age is given 30, sum assured is given, that is S here 50,000, and it must be payable at the end of year of death. Okay, then what will be equation of value here? We have to find P here. Okay, so I'll write here P A due 30, S is 50,000, and this is A 30. Okay, now this will be our equation of value. You need to solve this equation to find the value of P. You use the calculator to multiply 50,000 with A30, which is given in the table. This is also given in the table. Remember, this is given in the table, this is given in the table. The only unknown here is P. You have to find P. Okay, so if you have a annuity here, you have to see the table. Okay, X dues are given, X 30, 31, 32 up to 120, it's given. We'll see what is X now, but yeah, you have to do this way. Okay, remember the equation of value, it's very easy. Now let me write the equation of value. You have to solve it. Okay, let me write the equation of value in case of whole life. Okay, equation of value in case of whole life, then endowment and term. Remember, in this case premiums are payable annually in advance, even if it's not written. Then in this case it will be Px due is equal to Sx. Don't worry about the theoretical development of X due, we'll do that separately. And in this case it will be Axn, that should be equal to Axn. Again we'll see what is this one actually. And in the left hand side always you will have due when it comes to policies. Okay, finding premiums for the policies, because premiums are collected always in advance. If you say why there is no due initially, there was no term at all. In one time premium there is no term, only one P. Okay, now in case of term it will be this. Again there is a chance of confusion, there is nothing called 1 or 1 here. In case of annuity, again we'll see this, you need not to worry. Remember, this is called temporary annuity, this is called temporary annuity, this is called whole life annuity, that's all. Here this is called whole life assurance, this is endowment assurance, this is term assurance, term endowment. There is nothing called term here. In case of annuity we say temporary annuity, no term here. Why there is no one here, we'll see that. Okay, so remember, you will come across 3 kind of annuities. Let's do some problem. Okay, then we'll go and see what are the annuity functions actually. So the first example for you, find the annual premium payable in advance for a whole life assurance policy issued to a life aged 40 if the sum assured is 50,000 and is payable at the end of the year of death of the policyholder. This is the question. Mortality M92, interest rate is 4%. So let me write equation of value here. Equation of value, again EPV of income. Okay, here EPV of outgo. What you need to see here, annual premium, whole life assurance, sum assured, and when it's payable, and this mortality and interest rate. Okay, so that you can see the table. Now when you find annual premium, you have to write P A due age 40, sum assured 50,000. Then this is whole life A40. There is no bar here because this is payable at the end of year of death. Okay, so everything is given. Now we'll use these two as well, and we'll try to solve this one. Okay, the small x due is quite large as compared to capital X. Okay, we'll see that as well later, but just put the number 20.005, that is small x due. Okay, and 0.23056. $20.005, right?
Yes.
0.23056. Okay, 23056. Now you need to solve this to find the value of P. Okay, so for that we'll do this 50,000. You can use a calculator, divided by 20.005. I want to know P from you. Okay,
It's
or if you,
576.256.
okay, 576.256. Okay, all right, we'll accept this one. So logically you have to pay 576 at the start of each year if you are aged 40. Okay, it's like this. Let me draw here. The situation is something like this. Now the person is fit and fine and age is 40, and he has to pay this amount. Okay, 576.25 at the start of each year. Okay, in advance. This is the premium, 576.25 till the person dies. This is a whole life policy. Whenever the person dies, no amount will go to the company. Now company will pay here the sum assured. Okay, whenever the person dies, and the sum assured is 50,000 here. So this amount is payable by the company, but the policyholder will pay these amounts. Okay, many. So the income for the company will be so many, but the outgo will be only at one point. Okay, that is the end of year of death. Whenever the person dies, we write this. So we got the premium. Now let's do the next problem. Find the annual premium for an endowment policy issued to a life aged 40. Now term 20 year, sum assured 50,000, payable at the end of year of death of the policyholder or survival to the end of the term. So both benefits are here. So we'll write equation of value P A due 40 the age now, and it's for 20 years. Sum assured is 50,000. Then you can write A 40 20. Now if you ask me why there is no 1 here, anyway it's an endowment assurance, will not worry. Let's find the values. A 40 20. Now see, in this table it's not present. This is 4% M92, that's fine. Let's go down a bit. Increasing annuity will come, then we'll see those things. Now see, A due xn, okay, where x plus n, if you take x to the left hand side, x plus n will be 60. That means if x is 40, automatically n will be 20. Okay, so it's like this, M92, and we have to find this value. Okay, we have to find this value 40 20. So both are given here. One is 0.46433. and the second one is 13.927. Okay, you see A due XN here. You have to solve it to find the value of P. Okay, any help from your side? Use your calculator.
1,666.906.
1
666.906.
Okay, now the situation is this. There is a limit. The person has to pay premium at the start of each year 1666.90, this amount 1666.90 at the start of each year, 1666.90, and whenever the person dies, company will pay at the end of the year of death 50,000. This is there anyway, but there is a limit. This will work only up to 60. Let me write 59 here, 60 here. This is age line. I have not written the time. If the person dies after this, then there is a problem. Okay, so there will be no payment because this is term. But as this is endowment, we have a survival benefit as well. If the person dies, there is a benefit that's there anyway. If the person survives to the end of the year, okay, if the person survives to the end of the year, then also there is a benefit. If only one benefit is given, the survival benefit and the death benefit, they will be the same. Otherwise, in some questions, they talk about different amount of benefits. Sometimes survival benefit could be double the death benefit or 3 times as well. But here in this case, they are the same. Nothing is given means they are the same. The benefits are the same. So there are 2 types of benefits. If the person dies, definitely he has to pay. If the person survives to the end, then also he has to pay. Now consider this case. In this case, he has to pay these premiums continuously, okay, till this person dies. And if the person will not die, unfortunately, or we can say fortunately here, because this is endowment, okay, 1666.90, it will continue this way till here, because this guy is paying the premium in advance. Here this guy will pay for this year. This amount is for this year. This amount is for this year. This amount is for this year. This amount will be for this year. So there will be no more payment from the policy holder. He has already paid here. Now he survived. So company will pay 50,000. Okay. After this time, if the person dies, there is no benefit anyway. In case of term, there will be no survival benefit as well. Only death benefit. But this is endowment. Will not worry. Let's go to the next problem. Here the question is, find the annual premium for an endowment policy issued to a life aged 40 years for a term of 20 years. The same question, if the sum assured is 50,000 and is payable immediately on death, there is a slight change. Now the benefit is payable immediately on death. Okay, so we'll write equation of value. A 40, 20, there will be no change here. Bar will come here, okay, because now see, if you have doubt between this and this, okay, what you will do. So that's why I'm saying, remember, when we talk about the outgo of company, always we will talk about the right hand side. when you talk about the income of the company, we'll see the left hand side. Now we're talking about the outgo. See, it's like this. The person will continue to pay some amount starting from here, okay, starting from here, and it will continue till the person dies. Once the person dies, immediately here company has to pay sum assured. That is the difference, okay. And for that you have to write a bar here. So this has nothing to do with the premium collection, because the premium will be payable till here anyway, so there is no change. The only change is in the outgo. Instead of paying here, company will pay immediately, okay. That's where the change. So we'll not do anything more here. We'll write this way, A40 20, and this will be equal to P. Yeah, we have to do something more here. We have to divide this one, A40 20 1 plus A40 21. You have to do this way. And if you remember, this side anyway we have a value, we'll put here, but in this side here we have to use the approximation 1 plus I power half A40 20, okay, plus A40 20. And this side already we have done before. This is not available in the table, but this you can find this way, A40 21, that is A40 20 minus A40 21. This way you can find this term, and there is a formula for this, P40 20 V20, we know this, okay, plus this one is suppose M, okay. So let me write this way, here sum assured, whatever is sum assured we'll write here. This is M, suppose you have to write it here, and then P will be sum assured 50,000 here, M will find from this one, okay, and 1 plus I power half, I forgot to write here, you multiply it by S, then add this one, okay. We have to do this way because we have to separate this one. We can't apply the approximation formula directly in endowment, because in pure endowment the bar is equal to this one, they are the same, there is no difference, okay. So we have to separate, then here you have to apply the approximation, here it will be the same, I already explained. So that's why we have to find this way and solve it, find the value of P. Remember, once again I am repeating, there is no change in the left hand side. When we talk about the payment immediately on death, will only change the outgo part. There will be no change in the income part. Now this is example 4. The question is, find the annual premium for a term assurance policy issued to a life aged 40 years for a term of 20 years. The same question. Sum assured is 50,000 and the benefit is payable at the end of year of death of the policyholder. Mortality M92, interest rate 4%. The only thing is now it's a term assurance. So in case of term assurance, we have to write equation of value this way. Again, I am repeating here. Remember, there is no one in case of annuity. In case of annuity, we have only temporary annuity. No term concept is there. We'll discuss this once this problem is over. Then here you will get A40 20 1. This one you have to see from the table, okay. And sum assured is given, you can put 50,000, and this one is M, we already found here. If you check this way, we can find, because this is in the table, and this one already we know P20 P40 20 V20, okay. Then you know M, so you put here, that's all. So there is no one here. Even if it's term is for the right hand side, not for the left hand side, okay. Again, if you want to learn through diagram, when we say about term assurance policy, it works like this. Whenever the person dies, company has to pay the benefit. So how the left hand side will change? Left hand side will not change. Anyway, the person has to pay premium. till the person dies. The expected present value of this benefit is this one. We'll see this now. And the outgo will be here. So why there is a 1 here? Because there is no payment if the person dies here. If the person dies here, there is no payment. Okay. That's why we'll not change the left hand side and we'll change the right hand side. There will be no payment. That's why right hand side will change. Left hand side there will be no change. Till death he has to pay. That's all. And the maximum will come up to this only. After that the policyholder will not pay because the term is over here. The contract is over. Okay. The contract is over after 20 years. Now we'll try to find the expected present value. Okay. Now if I write 0 here and x here, the present is, then we'll continue 1, 2, 3 this way, like that, and this will be kx because the person is dying here, and this is kx plus 1. Now we are not interested in the sum assured. Remember when we started doing part 2, we talked about the outgo only. Now we'll not talk about outgo. We'll try to find something about, we'll try to do something about the income part, income for the company, when income will be in the form of annual premiums. Okay. But even we are not talking about income here. We are not talking about any policy here. This is an annuity. That's all. This is different from the part 1 annuity. How this is different from part 1 annuity? Let me tell you here. In part 1 annuity, whatever we studied before, we have something like this. 0, 1, 2, 3, let me write 4 here, 5 here, 6 here, okay, 7 here. If you find the present value of this, A7, that's all. So A7 is the present value of 7 ones, okay, payable in arrears. If one is payable at the end of this year, this one is for 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 this year. If it goes that way, the present value will be A7. Okay. 7 we find when we count. You count and you find 7. But there is no way you can count here. Because for the insurance company, the payments, the number of payments are not fixed. Suppose I write this way. Company sells a policy to people. Okay. Suppose this guy is A and there is another guy who is B. So what will happen? Maybe due to some problem, B will die early. B will die here. So B will pay, sorry, I'm not talking about this one, though practically it's always in advance. I've started with the arrear one. Okay. B is paying this way. Okay. 1, 1, not PP now. 1, 1. Okay. So B will end up paying two payments. Okay. Now what will happen? Suppose A dies here. What will happen is A will pay 1, 1, 1, 1, 1. Because A can't pay after he dies. So these are the payments company will receive from A, and these are the payments company will receive from B. So in this case, the present value is A2. In this case, the present value is A5. So you can fix a particular number here. Because till death, person will pay premium. After death, the policyholder will not pay any premium. So how can you fix this? Because we don't know the number of ones here. We'll not count this way. 1, 2, 3, 4, 5. Not that way. This is not 5. Dot, dot, dot I've written. Okay. Till the person dies, he has to pay. So if you find the present value, then even if we can't count, but we know this number. Okay. This number is kx. If you count this way, 1, 2, 3, 4, it will go up to kx. So the present value will be according to this. If you remember, I wrote A7 here. In normal annuity, if you see this one, 1 here, 1 here, 1 here, that way when you write and you find the present value, you get A7, okay, because 7 is here. Similar to this, if you find the present value here, present value will be AKX, okay. Yeah, this will look a bit complicated. In part 2, you will have a lot of new symbols. Remember, Symbols will be more. You need to remember. It's like this. A, K, where K is a random variable. K, X we have to write because X is also a variable. We'll apply it for each age. This is the present value. Okay. But don't worry. We will not use present value. Expected present value will use. There is a derivation. Okay. Expected present value will be AX. That's all. So let me write the present value. If you are not from statistics background, okay, if you have some problem here understanding the derivation, you need to do a little bit more of statistics. Okay, maybe 5 videos more. If you request me, I'll send you more videos. Okay, see whether you are able to follow or not. PV I've written here, AKX. Okay, remember where is the random variable. So if you have something like this and you are supposed to write this, which is similar to this, what we do, we write summation. If X is a discrete random variable, in capital we write small. Similar way we'll do this summation, we write small, then we have to multiply this probability. Capital X is small x. This is the formula. Okay, probability capital K is equal to small k. We have already used in the assurance function. Okay, this is AX and that is equal to summation K0 to infinity. Okay, this one, and this will be AKK default QX. If you remember, this will be K0 to infinity. There is a small derivation here. But anyway, this is not required now. We are interested in the left hand side that is given in the table. It will not come, probably I'm saying, probably it will not come in the exam, but you have to know. Okay, you put K0. I forgot to write this one. Okay, before writing K0, you write the value of AK. This is 1 minus Vk by I. Okay, so put K0, A0. It will start from 0. Okay. K.
Sir, here K is equal to 1 should come, right, sir?
1 should come, yeah, because we have taken in arrears, right?
Yes, sir.
Yeah. Okay. So now when K is equal to 1, you put K is equal to 1, A1. Then K is equal to 2, A2. Okay, that way we can put and we can see A1. If I write A1 here, this is 1 deferred QX plus A2, 2 deferred QX, A3, 3 deferred QX. You can write this way. Now X is equal to A1. A1 formula is there. Okay. So better we can write here as well. What is the formula for A1? Or maybe let me write here only. What is the formula for AN? Okay. AN, if you don't know, you can go and check this formula. This is B plus B square plus Bn, that is AN. Okay. I hope you remember this formula. This comes from the derivation. Okay, that is again equal to 1 minus Vn divided by I. We use this formula, but this formula came from this one. So we'll make use of this formula. A1 here, A1 is, you put N1 from 1 to 1, that is V. Even logically also you can think why A1 is V. What is A1? A1 is this, present value of 1, that is V. A2 is this. Present value is 1V, this one present value, this one present value, V square. If you add, you will get A2, right? This is A2, this is A1. Similarly, A3, okay? So, you need not to worry. Oh. Now, A1 will write V, okay? A1 is only V. then 1 deferred QX, and this one is V plus V square, two terms, present value of two ones, okay, that is A2, 2 deferred QX. Similarly, V square, V power 3, 3 deferred QX. You can continue this way, okay. Next, you collect the first terms. Here first term, here first term, where V is there, okay. So if you collect the first terms, you get 1, this one, here 2 deferred QX, from here 3 deferred QX, okay, this term. Then take V square common, okay. V square starts from the second term. So it will start from 2 deferred QX. Then write the third term, V power 3, okay. Suppose this one, V power 3, it starts from 3 deferred QX. It will go this way. Now we'll make it very simple, okay. There is an expression for this one, remember. We'll discuss that separately. We'll not make things complicated here. If you add, let me write here, 1 deferred QX plus 2 deferred QX up to infinity, okay. If you don't write also this one, this is Px1, okay. If you start from 2 deferred QX, separately I'll discuss about this. Remember, this is Px2. Logically also we can prove that one, but we will not complicate the things here. Ax will be, see, V Px1. Let me write V, the first one is Px1, then V square Px2, and plus V power, it will continue, okay. Let me not write anything, okay. This one, Px1 multiplied by V, Px2 multiplied by V square, Px3 multiplied by V power 3, that way. Let's not worry about this, okay. So the starting one will be the left hand side, that's all. And the general formula, let me write, we'll discuss that separately, which you can use here. You can start from K deferred QX. K could be 1, 2, 3, that way. Then it will be K plus 1 deferred QX up to infinite. If you write, that will be, this total will be Pxk, okay. This K and this K. If you start from 1, it will be 1. If you start from 2, all the terms I'm saying, 2. If you start from 3, it will be 3. That way it will continue. And the total in the summation form will write, that will be the final one, okay. And this formula will be useful. X will be summation V power K, okay, V power K, then here Pxk, K1 to infinity, that's all. This is the formula. This formula we have to use. The right hand side will use, and the left hand side, that you can get from the table. Now let's go to the second one, okay. Here, this one will use when we pay premiums, when the company collect premiums in advance. So if you count all the numbers here, okay, till this one, this is Kx. If you remember, part 1, when we write 0, 1, 2, 3, 4, you write 1, 1, 1, 1, 1 in advance. This is actually A5, not A4, okay, because it starts from 0. This one is for this year, 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 this one is for this year. So if you see a 4 here, you don't write 4. This will be A5 due, present value. Similarly here, if you see Kx is here, so if you count from 0 up to Kx, so you will have Kx plus 1 number of payments. So if you write PB here, this will be A due Kx plus 1 number of payments. Because it starts from 0, it will end at Kx. 0 to 10 means 11 payments are here. So when you find EPV, you will get Ax due. This is the notation. Remember, Ax due is the notation. Let me write properly. Ax due is the notation. Okay. So I can write here Ax due is the expected present value. Expected present value of a series of payments payable at the start of each year till death. Start of each year, okay. If someone dies, That's over. Next year there will be no payment. Whose present age is X, okay, or who is presently X, is the expected present value of a series of payments payable by a policyholder at the start of each year till death whose present age is X. This is X. This one, expected present value. This is present value. This is expected present value. We'll use mostly this one, expected present value. So again, you have to derive this one. We'll see how you will get, but remember the final answer will be again PXK VK, but here K will be from 0 to infinity. This will be the second one. Now the derivation, let's do here. This one, A due Kx plus 1, okay. When you find E of this, that will be summation A due in Kx, you have to put K plus 1, then probability Kx is equal to K. K will be from 0 to infinity, okay. So if you put K0, you will get A1 due now, okay. You should know what is A1 due. Then this is K default Qx, okay, remember. So if we put 0, it will be 0 default Qx. And the second one is A2 due 1 default Qx. And then A3 due 2 default Qx. It will go this way. Then A1 bar means 1. This is 1. You can check it from part 1 if you have any problem. 0 default Qx I have to write here. I can do anything else. Second one is 1 plus V square. Sorry, 1 plus V, the present value of two payments in advance. It's like this. One is 1, this is V. If you add, you will get the present value of two payments, that is A2 due. Then this one will be 1 default Qx, okay. 1 default Qx plus 1 plus V square, 2 default Qx. It will continue this way. Now, if you see, you have the first term 1 and it starts from 0 default Qx, then 1 default Qx. The first terms, you call it the first terms, okay. You get 1 multiplied by this, 1 multiplied by this, 1 multiplied by this, okay. So you have 0 default Qx. Let me write 1 multiplied by, the first one is 0 default Qx. Here also it's there, 1 default Qx. Here also it's there, the first term. If you multiply 2 default Qx, it will continue. The second one is V. V starts from 1 default Qx. So it's similar, quite similar. Little bit change, will not worry a lot. So this one, if you apply the formula, remember it should be K default Qx. Okay, sorry, P x0, and the second one will be P x1. And if you continue, this will be P x2 up to infinity. So if you write using summation, that will be summation Vk P xk, but K will be from 0 to infinity. So when you put K0 here, V0 is 1 and Px0, that is the first term, okay. This is the derivation. We will not derive the other two. See here, this was whole life, okay. If you see the diagram, there is no end here. This is whole life. Whole life annuity. These are whole life annuities. I've written or not? Okay. So let me write whole life annuities. Whole life annuities is over now. We'll go to temporary annuities. Okay. To temporary and see, there is a fixed, there is a term here. If you start from 0, okay, this is x1, x plus 1, 2, x plus 2. That way, if you continue, this is valid only up to term n. Okay, everything will happen, but that should be within a term. Okay, so if you find the present value here in arrears, that will be this one. Let me write the expected present value directly. Expected present value, that will be a x n. Okay, and if you write summation, that will be summation pxk vk, the same one. Okay, here k will be from 1 to n minus 1. Let me write the other one, due. If you make a due payment like this one, there is a term, fixed term, but it will start from 0. Then the present value you find, okay, and then EPV. Here PV, then EPV. EPV will be this one, okay. We'll do a lot of problems, and the 4 annuities will use. There is another one. This is the 4th one. Here you will have K0 to n minus 1, K1 to n. You need to remember the formulas, P, X, K, V, K. Okay, this one you will get for this. Okay, this one. Will not do the derivation part. You need not worry. Yeah, if the person survives, then also the same. Okay, it doesn't matter. This is not required at all in case of annuities. So let me write the 4 equations required. Starting from now till the end of the course, you will be requiring 4 annuities. Let me write these 4 annuities here for you. Okay, these are the 4 annuities. The first one is AX whole life annuity, and the second one is AX due whole life annuity due here. This is one. This is the second one. You need to remember the expression, though initially you will see the table and you will find the values, but the formulas you need to remember. Okay, this one is the first one, summation VK PXK. I wrote, you write this way, PXK VK, wherever you write doesn't matter, because we are multiplying. Okay, here K1 to infinity, and this one if you write here, you will have K0 to infinity. There is a link also, you can see later. AX due will be equal to 1 plus X. You can check this one. Okay, this is a simple relation, PXK VK. Now the third one will be AXN. I didn't derive this one, it's not required also. K, see, this is connection with this one. Okay, so it will start from 1, but it will go up to n, not infinity. And the fourth one will be A due XN. Okay, remember, we'll use these two mostly in problems, but these are also required. Okay, we'll use, but in the problems we'll use 2 and 4, because the premiums will always be paid in advance. Here K will be 0 to n minus 1, PXK VK. Remember, these are the 4 formulas you require. Even if you didn't understand whatever I derived today, if you know all these formulas, you will be through. There will be absolutely no problem. In all the problems we have to use. Okay, so you go through all these problems once again. How we have done, we have written the equation of value and we solve, and the problems will be like this only, but you have to know what is this formula, because if I slightly change, I will make this 5% and I will give a 2 or 3 term. You have to open this one, you have to expand. Okay, if you want to expand left hand side as well like the right hand side, then you will be needing these formulas. Okay, you put, suppose there are 3 terms you need to write, particularly here in this case, so you need to know this formula. And there are connections also. We'll do more for annuities. I need another class. We have continuously payable annuities as well, and we have just started. Like annuities in part 1, we are deriving the assurance functions and annuity functions.